they're out of cash. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a major foreign bank is facing an unprecedented bank run as depositors and huge depositors are fleeing en masse, putting the bank in a situation where it's facing an insolvency event and is now desperate to attract any kind of money at any price. And what I want you to see here is this story is not being touched hardly at all by the U.S. media. They're completely ignoring it, but the risks here are high. We have a global interconnected banking system. You have a systematic risk here. One bank goes down, it's going to topple through the entire system, and yet we here in the U.S., we face the exact opposite problem as banks allegedly have too much cash, but overseas, they're running out and running out fast. Let's over to the Wall Street Journal, where I want you to see where this story starts and just see how little coverage it gets as we get into the severity of what's going on. Credit Suisse stocks drops. Again, they're headlining the stock price drops, and the ADRs, or American Depository Receipts, touch a new low. Again, glossing over the real issue here, and money is fleeing the bank. As the Swiss lender, Swiss traded shares are currently down more than 6%. Its U.S. listed shares are down more than 7%. That puts the stock's losses over the past year at more than 65%, falling 96% from its all-time high of 2007. And again, they're going to completely gloss over the real issue here is they're saying the legal bills are a problem, stacking up to roughly $5.3 billion since 2020. But perhaps the bigger issue now, we get into the footnote almost, as the bank posted its fifth consecutive quarterly loss last month, alongside, here you have it, $100 billion worth of withdrawals from wealthy clients. So what you're seeing here is people who have a substantial amount of money that usually just park and let their money sit at the bank and earn interest are saying, you know what? I don't feel comfortable with Credit Suisse anymore. I think they're going down, and I want my money out, and I want it out in a big way. Now, from a bank's perspective, this is a huge problem because you need deposits to back assets. And if deposits flee, well, guess what happens to those assets? You eventually have to start selling them. And from a bank, that's a big problem because if you have to sell assets at a loss, well, now Credit Suisse's 5 consecutive quarters, well, it will look a lot worse. And now let's move over to Reuters, where we see Credit Suisse offers higher deposit rates in Asia to woo the wealthy. Again, we're not focusing on the issue here yet, but now you see they're offering higher deposit rates than their rivals to attract new funds from wealthy clients in Asia. And the Swiss bank is offering, get this, a 6.5%. This was the initial response, and this has already changed. We'll see that in a moment, on new 3-month deposits of $5 million or and above. And of course, the people on the inside, they weren't authorized to speak to the media, because if the media actually started to figure out what's really going on at Credit Suisse, is they've got serious problems, so bad that money is leaving and they have to offer an above average rate to bring assets back in. Well, you know you've got a big problem there. Credit Suisse is also offering a rate as high as 7% for one-year deposits, as the banking sector has been responding to global rate hikes with higher rates, and Credit Suisse is fully focused on providing our clients with differentiated advice and competitive solutions. That, according to a Credit Suisse spokesperson, but the reality is there's no reason they should need to offer an above-average rate to their clients. If that was the case, that tells you something is wrong at the bank, because otherwise, they would just put their rate at the same or about the same as their competitors, and everything would be fine. But you know a bank is hemorrhaging, you know it's on the verge of insolvency when the big clients have said they've had enough and they're leaving en masse. The offers are roughly 100 to 200 basis points higher. Get this, that's a lot of money. 1 to 2% higher than those of major rivals such as JP Morgan, UBS, and Citigroup. And of course, the competitors decided not to comment, as the new rates are higher than Credit Suisse's lending rates in Asia, according to one of two sources, adding that it raises concern how the business can sustain such a funding gap. And now we're starting to get the real issue of just how desperate Credit Credit Suisse is that they're not even generating enough return on their assets to pay these higher rates. Of course, the question is, will clients say, hey, you know what, I'll take a chance on those higher rates, which will just say that's the risk premium now of doing business with Credit Suisse, or are they going to look at the fact and say, wait a minute, if you're so desperate that you've got to offer a rate above what you're bringing in, well, maybe you're not going to be around a whole lot longer. And now we're starting to get to the real picture of what the Wall Street Journal missed and why the stock here is crashing. Citing sources, of course, we know they're offering a 6% and then 7% up to one-year deposits. Of course, the hope, this from Zero Hedge, is that after it attracts enough new clients, the bank will then be able to quietly lower the rates and make these new accounts profitable. But, of course, they're saying it doesn't always work that way. And this is what you call a new money rate. So if you're an existing depositor at Credit Suisse, they're not going to come and say, hey, if you keep your money here, we're just going to offer you this premium rate. What they're doing is they're going out to customers who are not, or potential customers who are not that at the bank, is saying, you bring us some new money and we will pay you a premium rate, a teaser rate. Of course, we all know what's going to happen is as soon as that teaser rate expires, it's going to go down, and it's going to go down a whole lot. And Credit Suisse is going to hope their customers, well, don't move their money. That's the game. Hilariously, the new deposit rates are higher than Credit Suisse's lending rates in Asia, as we just talked about. And how the question is, can it sustain the funding gap? Zero Hedge says it can't. As explained above, the bank is willing to eat into a short-term loss, adding to their 5 consecutive quarters of losses, in hopes of attracting enough sticky money before it flees again once the teaser rates expire. And sure enough, another source said offers are valid until the end of the quarter and only to new cash deposits, not existing portfolios. So again, Credit Suisse is willing to take a short-term loss here and willing to bet that money stays. Of course, they can also maybe go to the central bank and say, hey, we need some money to bridge the gap here, but they're making a big bet and is telling us that Credit Suisse could be the very first bank to fail. And asked about the lender's pricing to win back money during Credit Suisse's earnings call last month, the CEO said the bank is trying to be, quote, competitive like its rivals, but we are not buying assets, he said, just to be clear, because that would not be very smart going forward. Well, what do you think that raising your rate above your competitors is called? Buying assets. And of course, he said it's not very smart. That's what they're doing. It's a huge gamble. And of course, that could lead to a big problem of Credit Suisse toppling. And now let's go to the credit default swap market, which now all of a sudden is agreeing that Credit Suisse's days are numbered. As Credit Suisse 5-year CDS has widened, as shares plummet. The cost of insuring debt on Credit Suisse against default rose on Thursday as the shares fell to record lows. Their 5-year credit default swaps have widened 347 basis points from 344 at Wednesday's close. The shares in the bank falling as much as 10%. So what you're seeing here in these credit default swaps is the market is saying these are, again, insurance on bonds. You may remember this from the housing crisis, is these bonds are now they've been insured, and now the price to insure those bonds is going up because the probability of default, according to the market, is rising and rising substantially. But again, as we talked about in the beginning of the show, this is the exact opposite problem the U.S. banks are having. The U.S. banks, on the other side, allegedly have too much cash and now not enough assets. And of course, that's going to lead to more layoffs, as we're about to see. Surge in mortgage rates above 7% says homebuyer applications to 28-year low, a devastating statistic for the housing market. Here you can see in this chart here, mortgage applications, 28-year low. That means if you're working in the mortgage industry or the housing market, this is not a sign of business to come. It says there's a big problem. And there's further evidence, of course, we see that the U.S. banks have too much money, because what the U.S. banks here really need is they need people buying homes, creating mortgages, creating assets to back against all of this cash they have. Now, what's going to happen is the banks are going to keep their rate. the interest rate on their cash levels low. Of course, we know the Fed, as part of their cycle of raising rates, which they may raise them again later this month, is offering very attractive rates for people to park their money at the Fed on an overnight rate. Now, you can't access it directly, but you can indirectly access it through money markets. And if people move money out of the bank into a money market account, well, that's going to help the U.S. banks alleviate their cash problem. Well, until later on, when we, of course, know they're going to be desperate to get cash. And here we can see the overnight reverse repurchase agreements. This is the money parked at the Fed, $2.186 billion. The money is not going down, again, because the Fed is offering a very attractive rate. And here we can see loans and leases and all bank credit. The banks desperately need assets, but they're sitting at a little over $12 trillion in assets, and they're not growing much faster right now. They're starting to see a slowdown in asset growth. And of course, from the bank's perspective, we know what that leads to next, and that is layoffs. As Citigroup cuts hundreds of jobs, including in investment banking and mortgage units. And this, of course, is going to accelerate as long as the banks aren't bringing in new assets, because these cuts, now they don't sound big, less than 1% of Citigroup's 240,000 person workforce. Of course, we know that across the firm's operation and technology organization and U.S. mortgage underwriting arm are all those who are affected. And of course, we can note that this is only going to get worse as the economy continues to slow down, and we're going to face even more layoffs in the banks. The U.S. banks are going to be forced to layoff because they can't bring in enough assets and they need to shed cash. Meanwhile, the real risk to the global banking financial system right now sits overseas. Credit Suisse, number one, first bank likely to fail. Let's wait and see. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.